The big picture here is never mind the noise, never mind whatever happened last night. The macro setting that we talked about earlier is very bullish for gold. And most of it is in front of us. Like those rate cuts haven't happened yet. And if I'm right about the scales falling from their eyes and economists having an oh beep moment, we really are going into recession, that should be very good for gold. So if I'm right about that, it's extraordinarily good for gold. If I'm wrong about that and just the Fed does what it says it's going to do, that's still good for gold. I see this as a win-win setup going into the second half of this year, which makes me, I am, as soon as we got off this call, I'm going to go check some stocks on my shopping list and see if they're down with gold today because I want to buy.
The gold market is experiencing robust momentum, trading near session highs as U.S. inflation pressures align with expectations. This development has led some analysts to suggest that the Federal Reserve may have room to lower interest rates at the end of the quarter. August gold futures recently traded at $2,374.40 an ounce, up 0.88% on the day, reflecting the market's positive response to the latest economic data. Lobo Tiggre, a respected figure in the mining and resource investment sector and founder of Louis James LLC, offers a unique perspective on the current gold market dynamics. Dismissing the notion of regular smackdowns in gold prices, Tiggre points out that gold has maintained levels above $2,400 for weeks, an extraordinary feat. He suggests that $2,300 has become the new baseline, much like $2,000. Despite short-term volatility, Tiggre remains bullish on gold, citing macroeconomic factors. He believes that upcoming interest rate cuts and economists' potential recognition of a recession could significantly boost gold prices. As traders digest this information, attention now shifts to the upcoming release of the U.S. Personal Consumption Expenditures Price Index following Thursday's second quarter gross domestic product report. These economic indicators will likely be crucial in shaping market sentiment and future gold price movements. Technical analysis suggests that gold sellers maintain control, with the 14-day relative strength index holding below the 50 level, near 46. The market is testing the key 50-day simple moving average at $2,360. A daily close below this level could trigger a fresh downtrend toward the 100-day SMA support at $2,324. Please tune in for our exploration of Lobo Tiggre's expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. We appreciate your support.
We had this overnight smackdown, and before everybody says, oh, like clockwork, actually, it hasn't been like clockwork. I can even remember the last time we had one of these big overnight drawdowns in the gold dollar. It hadn't been this year. It's been probably more than a year since we've seen something like this. Gold's off $75 in 24 hours. That's a pretty big move. And it started just after 9 p.m. Eastern time. So this overnight thing is part of that. Like, why? Who in Asia decided suddenly to sell? A lot of fingers are pointing at Japan. I'm still digging into this. And the honest answer right now is I don't know. But the carry-on is not quite I don't care. That's a little too cavalier. Doesn't matter, I think is absolutely true. As far as the smackdown theory, let me first say, gold's been over 2,400 until yesterday for a couple of weeks. I mean, that's extraordinary. And so if you're going to say like smackdown like clockwork, well, where was the clockwork over the last 2 weeks? So I just don't buy that. And gold's, 2,300 has been the new 2,000 all year, just about. And 2,000 is a fantastic price for the miners all by itself. So the actual business of gold mining in the current context is a very actually good business. It's the kind of business that even a Warren Buffett could consider because the margins are there and there's a moat. It takes all these years to permit a new mine, even if new prices incent it. So a lot of good things to say about the mining business, and we're starting to see that in the stocks catching up with gold. So this is a good thing. But again, the big picture here is never mind the noise, never mind whatever happened last night. The macro setting that we talked about earlier is very bullish for gold, and most of it is in front of us. Like those rate cuts haven't happened yet. And if I'm right about the scales falling from their eyes and economists having an oh beep moment, we really are going into recession, that should be very good for gold. So if I'm right about that, it's extraordinarily good for gold. If I'm wrong about that and just the Fed does what it says it's going to do, that's still good for gold. I see this as a win-win setup going into the second half of this year, which makes me, I am, as soon as we got off this call, I'm going to go check some stocks on my shopping list and see if they're down with gold today because I want to buy.
The Chinese gold market is experiencing what some analysts call an unshakable bull market, driven by structural changes and economic uncertainties. Despite price sensitivity in the market, several factors are converging to boost gold demand in China, creating a complex and dynamic situation. Lobo Tiggre points out that China's cautious economic environment has unexpectedly benefited gold prices. He suggests that increased gold buying in China is primarily a result of consumers internalizing a grim financial outlook and seeking safe haven assets. This sentiment is echoed by broader market analysis. Lower interest rates and rising economic uncertainties fuel demand for gold, even as surging prices cool traditional jewelry purchases. This shift indicates a changing perspective on gold's role in personal and national finance strategies. At the national level, China's central bank has been on a notable gold buying spree in recent months, accumulating hundreds of tons. Analysts attribute these significant purchases to growing concerns about potential U.S. financial sanctions and questions surrounding the sustainability of U.S. sovereign debt. This move reflects a broader diversification and risk management strategy at the state level. Let's get back to the interview.
The lockdowns are now years in the past, but the unwillingness of the Chinese consumer or the Chinese businessman to invest or to expand or grow years afterwards tells you, I think, something of the damage they did by maintaining that long lockdown longer than necessary. I mean, it really put the fear factor into people. And not to harp on just gold, but that's been good for gold. I think that's been part of this story of China buying, is because people absorbed the lesson. This is really bad. The outlook is grim. And now we're seeing in the latest data, it seems like nothing they do is working. So I don't want to be the harbinger of doom here and say, oh, this is it. The collapse is coming. But, this is a serious thing. And I suspect that when push comes to shove, they will reopen the money floodgates. They're not just going to go quietly into the night and, let the thing collapse. The so-called social contract of China these days is, you can be an authoritarian dictatorship as long as we're making money. So if that contract is broken, she has big problems over there. To be continued, right? We'll see how that goes. But this definitely is worth watching. First and foremost, I am actually bullish on silver. The answer to your question is, one, if you look at the correlation over the last year, silver has correlated more with copper than gold. Now, all three have correlated, so that's not saying they're going in opposite directions, but it's just a fact. And it's an interesting fact. And it tells you something about how the silver market has changed. The other point is, even the most ardent silver bulls will tell you, in fact, as part of the sales pitch, that silver typically lags gold in a bull market and then more than catches up on a percentage gain basis at the end. That was true 100% of the time since 1971 and every bull market that we've had for the monetary metals until 2020. So you could say, well, gee, Lobo, that's still a pretty good track record. It only didn't work once. But it's significant that the time it didn't work was the last one. Like it worked until it didn't. So if that changed, if something changed in the market, like silver correlating more with copper than gold, right? You can't just ignore that. But that said, yes, silver is money. And actually recently, like this year, it's moving more tightly with gold. And you'll see that on days where copper and oil will go down and gold and silver will go up. Like some fear factor will drive safe haven demand, and silver acts like a monetary metal should. So I cannot foresee a very bullish case for gold in which silver just completely gets left behind.
Absolutely.
Right. And so, and the data is supporting that this year. So I started this year with no silver on my shopping list, and I put silver back on my shopping list, Darth silver and all.
Given the analysis of the current gold market dynamics and the strategic moves by major economies, particularly China, how do you foresee the future of gold prices? Will macroeconomic factors and potential interest rate changes continue to drive gold's upward momentum, or should investors prepare for increased volatility and potential downturns? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.